Thanks for your time. Here's a quick agenda, and you might notice the other gentleman on the screen we'll be speaking with in about 10 or 15 minutes is Greg Friedman from the Peachtree Group. We're really excited to have him on. First time we've actually had a chance to discuss commercial real estate with him in quite a couple of years, so I look forward to that. But first, we're going to get through some of our normal agenda items, looking at the economy, inflation, and where we sit with that. How it's impacting some of our asset class ratings to include stocks, bonds, and alternatives. And then we'll try to reserve the majority of the time for Greg at the Peachtree Group here towards the middle of the discussion. So with that, let's kick it off. Still, I would say emblematic of choppy seas are in front of us, but there's some, mixed currents here. What you're looking at on the screen again, just for those that aren't familiar, is a picture of the two broad segments of the economy, both services segment there in purple and the manufacturing segment there in orange. And what you might notice is starting in 2023, this year, there's been a pretty massive rebound in the services sector. Looked like it was going to dip below that 50 level, which would indicate contraction. It's moved back off that contractionary level into expansionary territory in January. And I think all that says is, despite the fact that we've got a number of headwinds, it's still a bit of a mixed picture from a global or US macroeconomic standpoint, because there is strength in a number of different areas and some weakness in other areas like manufacturing. So still a bit of a mixed bag. How is this impacting inflation? Well, this is that familiar chart you've seen me show before. The dashed line is what has happened on a year-over-year basis, or I'm sorry, month-over-month basis in CPI, the Consumer Price Index. The solid part of that blue line is what the expectation is, according to the market expectation. And then, of course, the rolling 12-month average. And you notice over the last couple of months, inflation has actually plateaued a little bit. So staying pretty firm at around 6.4, 6.5%. The Fed and others will do everything they can to try to get that down to the target range of between 2 and 3. But our opinion, that's going to be really challenging to get to, particularly with some of the strength we still have in the labor market. And I think the activity you're seeing today, particularly in the equity market, is reflecting that challenge, where Jay Powell, in testimony to the U.S. Senate, or I'm sorry, the Congress today, was mentioning that it might take additional rate increases in a longer period of time to be hanging out with the Fed funds rate a little bit higher than the expectation. So that tends to be our central tendency, and we're still pretty aligned in that, thinking it's going to be higher for longer. This is a familiar matrix of some of our themes. Continue to have a belief that there's going to be better opportunities on the horizon, so we need to be patient. In the meantime, during this patient period, it's going to be a bit of a no man's land. So, and this is liquid markets. Greg might have some other ideas on the private markets. But on the liquid side, the rate volatility as well as the equity market volatility is just emblematic that it's going to be pretty choppy for the foreseeable future until we get this inflation beast under control. Part of our idea, though, is that we do think there is some opportunity, particularly on the short end of the yield curve, which we'll show you in just a minute. And that, this bottom right-hand quadrant is a new quadrant that we've added since the last time. And, the idea that both can't be right. So either the Fed's going to be right or the bond market's going to be right. But those two different actors are showing very different outcomes over the intermediate term. And I think playing it a bit cautious until that resolves itself is really important. We'll show you that in just a minute. Looking at our investment ratings, it's still a fairly consistent picture of where we think capital should be allocated across the asset categories. US, particularly on the large cap side, we're still in a fairly neutral stance, but have seen some really attractive opportunities on the mid cap side. That's already been, I think, pretty positive of a shift for us so far this year. Developed markets, international, we still think there's some opportunities there, particularly with a starting point for the currency to be diversifying for those international positions could be an interesting place to hang out for a little bit of time, because we are at a place in the dollar index where it's at multi-decade highs and who knows exactly when that's going to shift. Bonds continue to be a bit of a, like I said, a bit of a no man's land, although we do have a healthy exposure to the short end of the yield curve, and we'll show you what that means here in just a moment. And then, on the alternative side, still, I think that's where things are getting really interesting because, in markets where there's less capital, those rates of return can be meaningfully different. So we still have a pretty healthy exposure, but also preference for alternatives, particularly at the expense of fixed income at the moment. Just a quick update, and then we'll shift over to comments to the private markets with Greg and Peachtree Group in just a moment. But stocks, I think, as we're seeing today, do look a little vulnerable here. Not to say we should be selling anything, but more the euphoria, I think, that's brought us to this point from January 1st till today is built a little bit on non-solid ground. And why do I say that? It's because right here is the bottom up estimate for earnings for calendar year 2023. So for the full year of 2023, at the beginning of the year, market was expecting $230 a share in earnings. And you can see over the course of the last few months, that level has migrated down to 222. Not that that's a huge shift or movement per se, mid-single digit shift downward, but it's really when you apply a multiple on top of that is where you get some convexity in the difference in where this price level, which is the dashed line, can end up. So, currently the fact that earnings have gone down and yet the market is up for the year doesn't really make a whole lot of sense to us. But, markets can be, forward thinking. So we want to make sure we're keeping an eye on that. But we still think that there might be some vulnerability built into equity markets right now, thus a sideways market for some time. As well, on the valuation side, I just wanted to share with you a picture of where the S&P started the year, forward earning estimate wise, and where we are as of last week. And you can see in almost every case, with the exception of emerging markets, which we still don't like, the valuation multiple across many different indices has gone up. And this is, of course, in the face of earnings going down. So we think there's going to be some working out to do between the market and the fundamentals. And so that's why we're still a little bit cautious right now at where we are, maybe shorter term. But again, this kind of feeds into our idea that longer term, maybe Q3, Q4, after this recession is kind of past us, where the market is fully discounted it, that we might see an upward progression in earnings again. Relating to the yield curve, this is the picture of the yield curve going back to January 1st of last year. That's the light blue line here of where the bond market was yielding at various points along the way. So a 1-year bond in January 1st of 22 was yielding 50 basis points or something. And now, whereas a 1-year bond yielding, you're all the way up here now, and you're over 5%. And so this is where we think there's quite a bit of opportunity still is to hang out in the short end of the yield curve until something materially shifts. One interesting comment, though, is that the market is fairly well anchored in the longer term inflation expectations. And you can see that in the 10-year and the 30-year bond. Those really haven't moved for the better part of the last 6 months. It's really only been the short end of the bond market that's moved a lot. And so, this does give, I think, the Fed confidence to think that they still have ability to influence interest rates with some of their policy tools. But the minute these start to move around a little bit, despite the fact they're saying what they're going to do, might be the tell that we are starting to lose control of the bond market. And then this is that great chart. I think I've only got one more before we turn it over to Greg here. This is that great chart that shares where some of this dissonance lies, whether it's between the markets and the Fed. And so what you see here, the orange line is the SOFR curve. This is a short-term lending rate. And the Fed funds rate here is in yellow. And then this is where the 10-year bond yield is. And the Fed dot plots, so I think it's every quarter, the Federal Reserve governors come out and say where they think the Fed funds rate is going to be in 23, 24, and 25. Well, if you remember at the beginning of the year, there was a big difference between 23, 24, and 25. I think it was the SOFR curve was down like this. But you can see what's happened more recently, and the reason why the 10-year has come back up quite a bit is that the SOFR curve is now adjusted upward in the shorter term, but still there's a bit of a delta here in 24. So all that's saying is that there's a bit of a dissonance here. in 2024, a little bit less so in 23 as we get closer to that eventuality. But we have to be mindful that this gap will need to be closed one way or the other. And it's, I think, in our opinion, not really prudent to take a lot of risk in the bond market, either through duration or through heavy credit exposure, if at all possible, while we wait to see how this resolves itself. So this is one of our, I would say, key areas of difference with where the market is at the moment. So just a couple of quick takeaways here. These haven't really shifted too much since the beginning of the year, but we still remain with a preference of stocks over bonds. There is a reason why stocks should have a higher return over the long period of time, given the equity risk premium. But we have to be patient. We have to wait for our opportunities, and that it's likely to be a sideways market for the foreseeable future. Still have a preference of alternative strategies over bonds. This has been a very effective shift for us over the last couple of years. But there's still quite a bit to do in the alternative markets, which we think is really attractive at the moment. And then, ultra short-term bonds versus maybe what's the money markets are paying you. Still, there's quite a bit of a difference between a one-year bond and a money market fund. And so we think this is still an interesting place to have capital at the moment, because you're not taking a lot of interest rate risk in ultra short bonds, getting a bit higher yield for taking on that small amount of extra duration. And so that seems to be a good allocation for us at the moment. Okay, well, I've kind of flown through some of my prepared comments, but I did want to give a little bit of time here to talk with Greg Friedman. He's the managing partner at Peachtree Group, previously known as Peachtree Hotel Group. We've had a lot of engagement with Peachtree Group over the years, and we thought this would be a great opportunity to bring Greg on to just give all of our clients and us in particular a sense of what's going on with commercial real estate and where they're seeing opportunities in the segments that they operate in. So Greg, thanks for joining us, and look forward to hearing what you guys have to say here in relationship to what's going on in your markets.
Yeah, no, definitely. Thank you, Todd. And we share very similar sentiments on how you're viewing the market right now. I think it's pretty interesting times. But before I get into more just the market view, just really quickly about myself for people that may not know me. I started Peachtree going back about 15 years ago. So it's myself, and I have two other partners in the business. Before starting Peachtree, I went to school at University of Texas at Austin. When I graduated Texas, I went into banking for about 10 years, where I specialized in financing hotel properties and other commercial real estate assets. With that said, just very quick as we go to the next slide, just the Peachtree, just for people that are not familiar with us, we are a sponsor of different investment vehicles that invest on the equity side or the debt side of commercial real estate assets, primarily hotel assets. So these are primarily branded hotels under the Marriott, Hilton flags. We own different companies that make up our ecosystem. We have a property management company, a development company, an investment acquisition company, a lending platform, an asset management company, and a couple other companies that really help to optimize and derive the returns of the different investment vehicles that we sponsor. And we think this ecosystem gives us a huge competitive advantage when viewing the market, but also making investment decisions. On the next slide, I guess, I would say just from an environmental, or from when you look at the environment today, you can just look at, there's such a constraint of debt supply. I mean, there's clearly less lenders in the marketplace actively lending, and we think that's creating an opportunity that we'll talk more about later. I think you can look at just the underwriting standards have become more rigorous as well, which is, in our eyes, again, it's a good thing, because it just creates an opportunity for us on the investment side. But this is a function of what's happening, just with higher interest rates, with concerns of us going into an economic recession. The availability of capital for real estate, primarily, debt capital, has been, very constrained, as you can see by the slide. The, one thing to mention is, you've got over, 400 billion, 440 billion of just commercial real estate loans maturing this year. So there's a lot of debt that's maturing, and these loans were originated in most cases years ago. So, back when interest rates and debt spreads were a lot thinner than where we are today. So ultimately, as these loans mature, they're going to be at, substantially higher. The borrowers are going to be borrowing at substantially higher interest rates. And we think, that's going to be potentially be a driving, force to potential opportunities here in the near future, just within hospitality alone. And this is just on the CMBS side, the commercial mortgage-backed securities market, which makes up about 25% of the debt market for hotel assets. You've got 16 billion of just hotel loans maturing this year. Again, we think, given all these loans are maturing and there's not a lot of debt capital available, we do think that's going to be a driving force to create some opportunities. The one thing I would just mention, just from a macro environment perspective, I think there's no question, inflation and higher interest rates are impacting asset values of all real estate asset classes or commercial real estate asset classes. Historically, hotels, as you'll see on the left side, has been less impacted by movements of the treasury rates. So with the 10-year treasury rate being around 4% today, the typical cap rate on most hotel assets today, and really over the last, you can see on the right side, hotels have historically traded in that 8 to 9% range on cap rates. And so cap rates haven't really moved over the last 10, 12 years, whereas on a lot of the other asset classes, you've seen this huge compression of cap rates. And so even with movements on the 10-year treasury rate, going back to my point, you still have a very good risk premium spread. So you still have over 400 basis points of risk premium spread to make it something that's worthwhile to invest into on the hotel side, versus some of the other asset classes. As you can see, cap rates have compressed down, and now they're and this goes to 2021, but obviously in 2022 going into 2023, we're starting to see cap rates reverse. And so you're seeing this, huge repricing that's taking place across assets. And, we think some asset classes are going to be more impacted. For instance, multifamily had compressed down in a lot of cases, because this slide's taking averages across all multifamily type assets on what traded during these time periods. But there was a lot of assets that traded in 2021 that traded, on the multifamily side, sub 3%. And now, with the 10-year treasury being around 4%, that's, in our eyes, the risk-free rate is, around 4%. There's really, it's negative leverage in a lot of cases, and, there's a negative spread there that exists. And so, there's going to be huge repricing. We still think it's going to exist on a lot of these lower cap rate assets. Going on to the next slide.
Hey, Greg, real quick before we move on, can you just give a quick sense for what a cap rate actually is for hotels, and then or assets and real estate in general? And then number two question would be, what accounts for the cap rate for the hospitality sector staying around that similar level that it has over the last 10 years?
Sure. So, the cap rate is, the net operating income coming off the asset, over the value of that asset. And that's what ultimately, makes up, the capitalization rate for these assets. The capitalization rates, and a lot of times, people equate it back to, risk. So they view it as, if you're investing in a risk-free investment, which today, again, I equate that back to the 10-year treasury rate. If you want to invest in something that's, longer term, that's around 4% is the risk-free rate. And then ultimately, as you invest in different asset classes, if it's multifamily, someone that's investing, they're saying if they're, effectively buying an asset, theoretically at $100 million of value, or excuse me, it's $100 million acquisition cost. The property, if it's a 3% cap rate, they're effectively, buying it with $3 million of net operating income. So that means that asset is producing, $3 million a year of net operating income before any debt service. And so without any leverage in place, ultimately you're making a 3% return if that's a 3% cap rate, versus a hotel. If you buy it, it's again $100 million asset and it's trading at an 8 cap. That means you have $8 million a year of net operating income, coming off that asset with no leverage in place. So there's a huge, increase of cash flows by taking on the hotel asset. To your other question, just looking over the last 10 years, part of the reason hotels have maintained such a higher capitalization rate is, one, hotels cash flows tend to be impacted based on economic cycles. coming out of the GFC, as you'll note, in 2011, 2012 till now, cap rates haven't really moved much. And part of the reason is hotels were really, the GFC was very severe to the lodging space. So hotels on the early part of the cycle really didn't get the benefit of compression in cap rates. And then when you look in the mid, period of time, around 2015 till 2019 or 2020, cap rates really didn't compress much. There was a lot of concerns about Airbnb and its ability to potentially disrupt the lodging business. And so in a lot of cases, people were worried that potentially hotels could be disrupted no differently than like the taxi industry was disrupted, by Uber, for instance. And I think now that's been, at this point in time, there's enough data to prove that that's not the case. So there was, some concerns, and that sort of held back some of the compression in cap rates, but ultimately just the concerns around potential economic, recessions have held back, where these assets have traded. And, interestingly enough, if you go back in time, going back to when I first got into the hotel business and really got into the, lending side of the business back in the late 90s, hotel cap rates and multifamily cap rates were very, very close to each other. There wasn't, a huge spread as you see that existed in 2021, for instance.
Got it. Thank you.
And so, when you look at the changes in interest rates and, inflation, ultimately the hotel business, it's a great hedge against inflation because, hotels average daily rates. So the ADRs or average daily rates actually move higher traditionally when we're in a higher inflationary period, because we're able to get the benefit of it because we reprice daily. So hotels tend to be the most effective, efficient way to hedge against inflation, just our ability to reprice daily. And so the other, question I get a lot just about what's happening in the hospitality industry, because there is inflation. A lot of people are concerned, well, with inflation, and looking at past cycles, as well as what's even happening today, as there is inflation, that means your expense must be growing as well. And that is correct to a certain degree. But what we've found is with inflation, in looking at the past couple of cycles, inflationary cycles, we've found that the inflation growth rates have ultimately been exceeded by what's actually being driven at the bottom line. So the NOI growth rates have exceeded by a pretty nice margin, by like 140% of what the inflation growth rates are. So hotels become more profitable in these higher inflationary periods. And that's what we're experiencing across our portfolio when you look at what's happening compared to, pre-pandemic levels. We are running at higher gross operating profit margins. And that's partially given the fact that, we are charging higher rates. The additional expenses that we have on the salary and wage side of the ledger is, definitely impacting us, but ultimately it's not impacting us enough to, offset the gains that we're getting on the higher average daily rates that we're charging at the hotels. And then ultimately, just from a metrics or, what's happening at hotel assets in general, just at the asset level, because obviously I think everyone on this call realizes 2020 was was probably the worst year for lodging altogether of all time. Hotels have rebounded extremely nicely over the last couple of years or over the last 18 months. We're now, if you look at even in 2023, in the face of an economic recession, most industry pundits are expecting us to be in a recession in the latter half of this year. And even forecasting a recession, people are still expecting, just given how much pent-up demand there is for travel, that revenue per available room is going to grow through a combination of continuing to get additional growth in average daily rates as well as occupancy. And so, ultimately, we believe the perfect storm is being created just from a standpoint of what is investable in this cycle when you look at commercial real estate, because, you have obviously, rising inflation, higher interest rates that we've talked about. There's a lot of debt maturities. There's a lot of fatigue in the market too. And the lodging industry itself, as I mentioned, has, fully recovered in most cases back to pre-pandemic levels and is more profitable in a lot of cases to what it was doing pre-pandemic as well. So ultimately, all this creates a scenario where, we see a huge opportunity just on the lending side of the business. And that's what we've been focused on as an organization, where in a lot of cases, because there's this lack of debt supply that we talked about earlier, we're able to lend at, higher spreads. Index rates have moved up as well. So ultimately we're getting equity-like returns, lending at 60 to 75% of the acquisition costs, or, providing 60, 75%, development financing, or in a lot of cases, even recapitalizing loans that are maturing. We're able to come in at 60 to 75% of the current value of these assets. And we're getting, gross returns that are very similar to where you're seeing, equity returns should be without taking on that last dollar risk. So we believe there's a huge investment opportunity on the direct lending side. We've been taking advantage of that. We've also seen, and we do believe we're at the very beginning stages of two different acquisition opportunities. One is on the note purchase side, the ability to buy debt, because there's a lot of financial institutions continue to look to delever their exposure to commercial real estate. And we think that's an opportunity that's going to continue to grow this year, as well as we're starting to see a lot of opportunities to buy real estate at discounted levels, or at opportunistic levels, just given the fact that there's all this pressure being driven off of higher interest rates, especially when loans are maturing and groups have to refinance at higher interest rates, as well as just especially on the hotel sector side. There's a lot of fatigue in the market because a lot of ownership groups have had to make it through the pandemic, where they've wiped out a lot of their interest reserves. They don't have a lot of, and beyond wiping out their interest reserves, they've wiped out their CapEx reserves and exhausted those reserves. And so they don't have capital available to do renovations. They don't have capital necessarily for pay downs that need to exist. And so a lot of that, we believe, is going to be the motivating factor for a lot of real estate sales, hotel real estate sales later this year, where you can buy assets at opportunistic levels. So we're very excited, and we believe hospitality across the different asset classes, hospitality may be the most investable asset class right now, just given all the secular trends that you're seeing, within our industry especially on the travel spend side, coupled with the fact that hotels, going back when we looked at the slides earlier with higher cap rates, and just, the other factor is there's just a lack of new supply being built in the hotel industry because of the pandemic that, restricted a lot of the new supply. And then now the current dislocation in the debt markets have also, continued to hinder any new supply being built. So again, we think there's a lot of, really good tailwinds on the demand side for lodging, but more importantly, we think that, just the, beyond all that, we think hotels, represent probably a better risk-adjusted return, just given some of the components I've mentioned earlier. Just going on to the next slide, I think is, yep. And so, ultimately, this is sort of what I was talking about before, just there's a lot of opportunities to be able to lend at higher yields. We think there's going to be the opportunity to buy, mortgages at discounts from banks, like we did during the pandemic. We bought over 180 first mortgage loans from different financial institutions, mostly, publicly traded banks. We think that opportunity is going to exist later this year. It hasn't existed, or hasn't been that compelling at this point to buy debt. We think that opportunity will get more compelling as the year goes on. And we also believe that we'll be able to, buy hotels opportunistically later this year as well. So,
yeah, very good.
That said, yeah. So I'll turn to some questions.
Yeah. Well, Greg, thanks for sharing some of your insights here. Just a quick question that came in, or that I had that I needed to ask you. There's been a lot of talk, and I'm going to ask you to step outside of your lodging industry just for a moment, into maybe other parts of real estate. But we hear a lot of anxiety or issues that are brewing about in office space. Clearly, there's that's a sector that needs to have its own reckoning, if not already. Where do you think we are within that progression, and what are your thoughts on just office and broad? I know it's not your specialty, but I'm sure you've got some thoughts there. So I'd love to hear your thoughts on that.
Sure. And so, my comments are going to be more macro driven, because I do think there's some opportunities in office. I think it's very early, to find those opportunities. And there's probably, like anything else, I think, as you look at office today, it's very, at least from my perspective, it's very uninvestable, because there's still a lot of questions about the recovery of office and how it's going to look. I think if you're going to, invest in office, I think you've got to be, very strategic and thoughtful. We're seeing the opportunity to buy a lot of discounted debt. There's a lot of that on the street right now. And a lot of that debt we're looking at, you need huge discounts in order for it to make sense to buy, at least for us to be able to even buy it. So I do think office has a longer recovery horizon. I think there's this whole issue between hybrid work model, working remotely or the return of office. I think if you want to look at if you want to take the opportunistic side of office, or excuse me, if you want to take the optimistic side of office, not the opportunistic, but the optimistic side of office, you would probably point to the fact that a lot of companies are starting to require people to be back in the office 3 days a week, which gives some hope of maybe offices getting a little bit oversold at this point. But I don't think necessarily that's fully the case, across the US. I think, clearly yields have moved up on what it takes to invest in office. And I think it's going to take time for the office sector to recover. But ultimately, I think there's going to be opportunities there. It's just, I think the discounts you're going to need in order to buy some of these loans secured by office buildings, or even buying them outright, is going to be very substantial. And it's going to take a little bit of time to work through the system. And I think there is a separation between the office that has more of an experience, side to it associated. Like if you're in a location that has a lot of good support amenities around it and very walkable, versus office that's suburban office that has, that's older suburban office that has nothing compelling. I think that's going to be more challenged going forward.
Yeah. Very good. Well, I think actually you've addressed most of the ideas or questions that people had. One that I noticed in your slides, you were talking about a maturity wall coming or that's coming down the road. And as I recall, there was a talk about that being an issue back in the mid 2010s or later 2010s. And I guess a lot of the refinancing was able to occur because of COVID. Interest rates went to zero or went down super low, and that a lot of that was refinanced. Would you just describe really what that means from like a CMBS side, or what is like maturity wall, either relationship to bonds themselves or interest rate caps?
Yeah, so the maturity wall is really as loans are maturing. So ultimately, especially if it's CMBS loans, most of these are fixed rate loans, and so when they mature, at that point in time, the borrower is going to have to go refinance at current market terms. So I think, from my perspective, that's going to, obviously impact cash flows. And in a lot of cases, these fixed rates on the CMBS loans were done in the, for hospitality, at least, was done in the, 4 to 5% range. To get a hotel loan today, you're looking at paying, somewhere around, on a fixed rate basis, assuming it has good in place cash flows, you're probably paying 7 to 8% type fixed rate. So you're almost doubling your cost of just interest. So that's putting a lot of, stress on the assets. And that's going to have a huge factor. And then there's also, beyond these loans that are maturing, there's a lot of floating rate loans out there that had interest rate caps, to your point before, that were done in the CLO market, which isn't necessarily tracked here or is not showing up here, where the caps expired over a certain period of time. Because a lot of groups will go in and they'll take a 3-year note and have a couple of 12-month extension options, and maybe they structure it where the cap is only good for 24 months or 36 months. And they'll turn around and say they'll buy another cap at expiration in order to reduce upfront costs when they're doing that refinance. Well, now all of a sudden that cap cost for where they need to, buy a new cap in order to make sure the underwriting works is very substantial to the balance. And in a lot of cases, we've seen situations where groups need $6 or $7 million in order just to buy a new cap and to continue to stay in compliance on their existing loan. And so that's creating, again, those are driving forces to create opportunities to cause groups to opportunistically sell assets. In a lot of cases, that's driving them to sell assets at materially lower levels than what the underlying intrinsic value of these assets are. Because going back to 2020, to your point, there was a lot of concerns about loan maturities and how groups were going to be able to refinance. But obviously, the debt market recovered a lot quicker than most people expected, especially on the CMBS side and the CLO side. This time around, I mean, the CMBS market, the CLO market is very inefficient today. Banks in general, they had a lot of, during the pandemic, banks had coverage through the CARES Act, so they were less concerned with loans maturing. They weren't as concerned about TDRs, troubled debt restructures. Unfortunately, banks don't have that coverage today. So as loans are maturing, if it's with a regulated bank, if it's with a CMBS lender, CLO lender, there's not a lot of flexibility in general, and there's not a lot of capital out there to backfill it. So I think this is going to be, my personal opinion, 2023 and 2024, barring something that happens unexpectedly, where all of a sudden the debt markets and the capital markets open back up. There's going to be, I believe, a huge need for private capital from groups like, Peachtree to come in and provide, either debt capital or preferred equity or mezz debt to help, bridge the gap in order to get a lot of these assets refinanced. So there's going to be a lot of opportunities on the debt side. And I think that opportunity is just starting to exist now.
Right. Yeah. Thanks. Thanks for your comments. And I just want to say thanks to Greg for taking some time out of his busy schedule to come join us and share some thoughts on the market. Definitely value add. I think I learned something new every time we have a discussion. So much appreciated, Greg. But just wanted to say thanks to all the clients for joining in today, and look forward to seeing you here on the next one next month.